Hello, this is Suen from the Alternatives team in Singapore. Now, today we've invited an expert from New York, John Ancona, the co-head of private equity due diligence for jpmorgan Private Bank, to discuss the construction of private investment portfolios. John, can you discuss why does private investments outperform public investments, and how much of your overall portfolio do you recommend investing into private investments?
Thanks, Suen. Yeah, we generally look for 300 to 500 basis points of outperformance for private equity as an asset class. And I think if you were to look at the long-term capital markets assumptions, that's really how we feel, both historically and forward-looking, what the asset class has delivered. Why is that? A function of a bunch of different things, really. Private equity managers have the value of time. They can pick when they're going to exit their businesses and when they're going to get in. And just having that additional capability, they're able to monetize some of the volatility that comes along with asset classes, underlying asset classes. Along with that, I think is really that long-term outlook, being able to go in and make short-term investments that may not generate returns in the immediate future, in the next quarter, the way a public market management team might be focused, but are going to have long-term payoffs in terms of driving forward growth of business, cutting significant costs over time in intelligent ways. That long-term payoff really does deliver in a private equity context. I tend to think of it as the Goldilocks approach, right? We're talking about 5-year holding period. So immediate enough that we can have tangible effects on the business. We're not talking about what's the 30-year outlook for something and investing for indefinitely far into the future, but we're also not focused on this real short-termism, quarter-to-quarter management that we often see in the public markets. How much of your portfolio should be in private equity? Obviously, it depends on your underlying liquidity situation. I would say typically we see 5 to 15%.
Now, a well-constructed private investment portfolio should be self-funding over time. Now, given that private equity funds are typically self-liquidating, as well as they frequently do not draw 100% of the total commitments, John, what are the key considerations for constructing a private investment portfolio?
Yeah, a couple of folds. First, as you say, Suen, a portfolio never gets 100% funded. A good rule of thumb, if I look at the vintage portfolios historically, something like 75% is your peak out of pocket, because as you're in that last year of capital call activity, you're starting to get distributions from some of the first years of capital call activity that you saw. So, a little bit of overcommitment makes sense as you're trying to think about what your target allocation is as your portfolio gets mature. The second really important thing is to think about laddering. Private equity is a great asset class, and I think we do a very good job of picking individual funds. But one of the single biggest drivers of performance is any given vintage year. That'd be great if you could predict which were going to be the great vintage years and which weren't. But that really is, no one has that crystal ball. And so allocating year in, year out and diversifying over time is a really, really important part of how you think about building that portfolio, both in terms of return, but also in terms of laddering those cash flows and getting to a mature self-funding portfolio. That's ultimately, as you say, the holy grail of what we're trying to do.
So last year, there were almost 5,000 private funds that were in the market for raising private capital. And our due diligence team, your team, had more than 950 meetings to select 15 to 20 different opportunities for our clients to access in 2020. Now, this intensive diligence process is built on the foundation of our 4P framework. And John, can you elaborate why do we spend so much time on diligencing?
Of course. We don't take all those meetings just for the fun of it, although, diligence professionals do enjoy those types of conversations. We take it because it really informs the types of funds that we're ultimately going to pick. As generalists across the industry, we want to make sure we've seen everything in a particular corner. If I'm looking at healthcare and I've met 20 different managers to find one specific fund, I'll have a really strong view of how they comp to other parties that they're competing with, investing against, but also have a really good view of what those market trends are and what market consensus is, how this manager compares in all those ways. So that's really why we're casting this very, very wide net to filter down. I would also say private equity is a high burden for investment. We're making a really big promise to managers. We don't have the ability to get out of funds the way we do on the hedge fund side or the mutual fund side. Because of that illiquidity, we've got to be really, really comfortable that we've done an excessive amount of work upfront in order to feel comfortable about the investment we're making. It comes back to those 4 Ps. What are they? People, performance, process, and philosophy. Start with the first two, which I think really inform the latter. We spend a lot of time on performance, not because we're going to experience that performance going forward. The bottom of those pages you see says past performance is not indicative of future results, but because it does inform what a manager has done before and what we think they might do in the future, right? What is their style of investing? How have they been able to generate returns historically? Not just top line numbers, but what's driven those on a bottoms up basis? Is this a manager that creates returns through financial engineering, through fundamental operational growth, through cost cutting? What's the flavor? And people, just as important, are the people that generated those returns historically still there? We passed on funds with great numbers where it was generated by a senior individual who's on the verge of retirement. And similarly, we've looked at funds where the headline numbers might not have been so impressive, but there was a cohort of really young partners up and coming who are really strong performers. All that comes back to process and philosophy. I'd say the fundamental question we're asking in diligence is, how does this manager generate returns? And is that something that we think is repeatable going forward, given everything we know about both macro markets and then this manager specifically, the way they're set up, the individuals that are in the seats on the investment committee? That's the fundamental question we're trying to answer through diligence.
Thank you. Now at JPMorgan Private Bank, we can help you to implement a private investment vintage program with our decades of investment experience and access to top quartile managers.